They were written in gold for a reason. Not silver, not copper. Gold, the most precious, most enduring, most universally valued substance in human history, chosen deliberately, chosen specifically, because what these rules represent deserves nothing less. These are not new rules. They were not discovered last year by a trading influencer with a YouTube channel. They were not generated by an algorithm or revealed by backtesting software. They are old. Old in the way that truth is old, unchanged across decades of market cycles, technological revolutions, and everything that the financial world has thrown at traders who dared to participate in it. Jesse Livermore knew them. He violated them and lost fortunes. He followed them and made fortunes. He wrote about them in 1940, 84 years ago, and every word still applies to the trade you will take tomorrow morning. Paul Tudor Jones knows them. George Soros knows them. Every trader who has achieved sustained, consistent profitability across multiple market cycles knows them. And yet, walk through any trading forum, scroll through any trading community, listen to the stories that consistently losing traders tell about their losses. The rules are absent. Every single time, not because the traders do not know them. Most traders have heard every one of these 5 rules, because knowing a rule and following a rule are 2 completely different things. And the distance between knowing and following, that gap, that critical, costly, account-destroying gap, is exactly where most trading careers go to die. Today, that gap closes. Why traders ignore rules they know are right. Before the rules, we need to confront the uncomfortable truth that makes breaking them almost inevitable. Unless you understand what you are fighting. The human brain did not evolve to follow rules under emotional pressure. It evolved to survive, to respond to immediate threats, to seek immediate rewards, to avoid immediate pain. Every neurological system that governs behavior in your brain was shaped over hundreds of thousands of years of evolutionary pressure, and not one moment of that evolutionary pressure involved the need to hold a stop-loss in place while a trade moved against you. When you are in a losing trade, and your stop-loss is 50 pips away, your brain does not experience the situation as, this is a normal part of my trading system, statistical distribution of outcomes. It experiences it as a threat, real, immediate, neurologically indistinguishable from the threats your ancestors faced on the savannah. And when the threat response activates, when cortisol floods your system, when the amygdala fires, when the fight or flight mechanism engages, the prefrontal cortex goes offline. The prefrontal cortex, the part of your brain that knows the rules. This is not weakness. This is neuroscience. And it means that following rules under emotional pressure requires something that willpower alone cannot provide. It requires systems, pre-commitments, external structures that govern your behavior in the moments when your neuroscience is working against you. That understanding is what transforms these 5 rules from intellectual knowledge into actual behavioral change. With that understanding, let us begin. Golden Rule 1. Never risk more than you can afford to lose on a single trade. This rule sounds so obvious that most traders read it and nod without truly absorbing it. They already know this rule. They just do not follow it. Here is the specific, measurable way this rule is violated. Not in dramatic, obvious ways, but in the subtle, incremental, deadly ways that destroy accounts slowly. A trader defines their risk as 2% per trade. Reasonable, disciplined, professional. Then a setup appears that is exceptional, better than anything they have seen in months. Every element aligned, maximum conviction. This one is different, they think. Sizing up to 5% on this trade is not reckless. It is responding appropriately to an exceptional opportunity. 5% per trade. A losing streak of 5 consecutive trades, which any strategy with less than a 100% win rate will produce, reduces the account by 23%. Psychologically devastating. Often account ending, not because the math is fatal, but because the emotional damage of a 23% drawdown produces the desperate, compensatory trading that finishes the job. At 2% risk per trade, the same 5-trade losing streak reduces the account by 9, 6%, uncomfortable, manageable, Survivable without lasting psychological damage. The golden rule in practice. Define your maximum risk per trade as a percentage. Write it down. Calculate the exact dollar amount it represents at your current account balance. That dollar amount is the maximum loss you will accept on any single trade, regardless of setup, quality, regardless of conviction, regardless of what any external voice tells you about the opportunity. Set this as a platform-level rule if your platform allows it. Automate the enforcement. Remove the discretion that your emotional brain will exploit in moments of maximum conviction. This rule is not about being conservative. It is about being in the game long enough to let your edge work. Golden Rule 2. Always define your exit before you enter. The moment you enter a trade, your objectivity is compromised. This is not a character flaw. It is a documented psychological phenomenon. The moment we commit to a position, our brains begin working to justify that position, rather than evaluate it objectively. Confirmation bias activates. Loss aversion engages. Every subsequent piece of information is filtered through the lens of the position we have already taken. This means that the worst possible moment to decide where to exit a trade is after you have entered it. Yet this is precisely when most traders make that decision. They enter. They feel the emotional pull of the open position. They watch every candle form with the desperate hope that it will move in their direction. And when it moves against them, when the loss grows, and the stop decision can no longer be avoided, they make the decision under maximum emotional duress. The result is almost always the same. The stop is placed further away than logic justifies. The trade is given more room. The loss that should have been 1% becomes 2%, then 3%. Then the position is so large that closing it feels psychologically impossible, and the trader holds until the account is destroyed. The golden rule in practice. Before entering any trade, write down 3 specific prices. Entry. The exact price at which you enter. Stop loss. The exact price at which the trade is invalid. Not the price that produces a comfortable loss, but the price at which the reason for the trade no longer exists. Take profit. The exact structural level where you exit with your planned profit. These 3 prices are defined before you enter. They do not change after you enter. Set them as platform orders the moment the position is opened. Hard orders that execute automatically without requiring any action from your emotional, compromised, post-entry brain. This rule transforms exit decisions from emotional real-time reactions into rational, pre-trade commitments. And rational pre-trade commitments, followed consistently, are what produce consistent results. Golden Rule 3. Trade with the trend. Always, this rule has been spoken by every great trader in history. Jesse Livermore. The big money is made by the sit-in and the wait-in. Waiting for the trend to be clearly established. Paul Tudor Jones. The trend is your friend until the end when it bends. Ed Seykota. The trend is your friend, except at the end where it bends. 3 of the greatest traders who ever lived. Different eras, different markets, different instruments, all saying the same thing, with almost identical words. And yet, the number of retail traders who consistently trade against the trend is staggering. This has gone down too far, it must bounce, buys in established downtrends. This rally cannot continue shorts in roaring bull markets. The conviction that the trader's analysis is right and the market is wrong. The market is never wrong. The trend exists because the largest, most well-capitalized, most analytically sophisticated participants in the market have collectively decided, with real money, real positions, and real consequences, that price should move in that direction. Fighting that collective decision is not brave analysis. It is financial self-destruction, dressed up as independent thinking. The golden rule in practice. Before every trade, answer one question. What is the dominant trend on the weekly chart? If the answer is up, you take long trades only. Short setups, no matter how compelling they appear on the daily or intraday chart, are ignored. If the answer is down, you take short trades only. Long setups are ignored, regardless of how bullish the daily chart looks. If the answer is unclear, no trend is established, you wait. You do not trade until directional clarity returns. This single filter, weekly trend only, no counter-trend trades, will eliminate the majority of your largest, most devastating losses, because the worst losses in trading almost always come from fighting an established trend. Stop fighting, start following. Golden Rule 4. Cut losses quickly, let winners run. This rule is the most quoted in all of trading literature. It is also the most consistently violated. The reason is psychological and precise. Loss aversion. The documented human tendency to feel losses approximately twice as strongly as equivalent gains creates two specific, predictable behaviors in traders. First, it makes cutting losses painful. Closing a losing trade means accepting that a loss is real, permanent, and final. As long as the trade is open, there is hope, however irrational, of recovery. The brain prefers the pain of ongoing loss to the finality of a confirmed one. Second, it makes letting winners run terrifying. The moment a trade shows profit, loss aversion activates around that profit, protecting the gain, generating the impulse to close before the profit disappears. The brain experiences unrealized profit as something fragile, temporary, and perpetually at risk. The combined effect of these two tendencies is mathematically catastrophic. Losses run further than planned. Winners close earlier than planned. The average loss grows larger than the system designed. The average win grows smaller than the system required. The mathematical edge that justified the strategy is destroyed not by bad analysis but by behavioral violation of this single rule. The golden rule in practice. Hard stop losses. Set before entry. Never moved against the position. This is the mechanical enforcement of cut losses quickly. Hard take profits. Set at the structural target before entry. Never move to lock in early profit. This is the mechanical enforcement of let winners run. Between entry and exit, your only task is to monitor whether the structural basis of the trade has changed. Has the weekly trend reversed? Has a major structural level been violated in a way that invalidates the original analysis? If yes, close the trade, regardless of current profit or loss. If no, the orders do their job. You do nothing. Cutting losses quickly and letting winners run is not an act of willpower in the moment. It is an act of pre-commitment before the moment arrives. Golden Rule 5. Never trade to recover a loss. This is the rule that most traders break immediately after a significant loss, and it is the rule whose violation causes more account destruction than any other single behavior in trading. The psychology is straightforward, but devastating. A significant loss creates an immediate, powerful need to recover, to restore the account to its previous level, to prove that the loss was an anomaly rather than a reflection of incompetence, to silence the internal voice that says, "You cannot do this." This need, urgent, emotional, overwhelming, drives traders back to the market immediately, after a loss in a state that is the precise opposite of the calm, analytical, patient state required for good trading decisions. The recovery trade is taken not because a genuine setup has appeared, but because the need to recover demands action. The position is often larger than normal. To recover the loss faster, the entry criteria are often looser than normal, because waiting for a perfect setup feels intolerable. The emotional state is compromised, because the previous loss is still fresh, still raw, still influencing every perception. The result is predictable. The recovery trade loses. The account is now down more than before. The emotional pressure intensifies. Another recovery trade is taken. Another loss. The spiral accelerates until the account is critically damaged or destroyed entirely. The golden rule in practice. After any loss, regardless of size, regardless of cause, implement a mandatory cooling period. Minimum, the remainder of the current trading day. Preferred, 24 hours. For significant losses, 72 hours, or until the emotional charge of the loss has genuinely dissipated. During the cooling period, you review the trade. Was it a system failure? Did you violate a rule? Or was it a statistical outcome? Did you follow all rules and lose anyway? If system failure, identify the specific rule violated and recommit to it before trading again. If statistical outcome, accept it as a normal cost of participation and return to trading with your system intact. Under no circumstances do you return to the market, driven by the need to recover a loss. That need is the voice of your emotional brain, the brain that responds to losses as threats rather than as statistical events. That brain should not be making trading decisions. The calm, analytical, rule-following brain should be, and that brain only regains control after the emotional charge of the loss has been given time to dissipate. The 5 golden rules together. The complete system. Rule 1. Never risk more than 2% per trade. Always. Rule 2. Define entry, stop, and target before entering. Set as platform orders. Step away. Rule 3. Trade with the weekly trend only. No exceptions. Rule 4. Hard stops. Hard targets. Never moved. Let the orders do the work. Rule 5. After any loss, mandatory cooling period before the next trade. 5 rules. Not 50. Not the contents of an entire trading course. 5 rules, followed consistently, that address the 5 most common, most costly, most account-destroying behavioral failures in retail trading. The traders who follow all 5, not most of the time, not when it is convenient, but consistently and without exception, are the traders who survive the learning curve, develop genuine consistency, and eventually achieve what they came to trading for. The traders who know all 5 and follow them selectively, picking and choosing based on emotional convenience, are the traders who will be back at the beginning of this article in 6, wondering why nothing has changed. Conclusion: the gold was always there. These rules were not hidden. They were not locked in a vault, accessible only to professional traders and institutional participants. They have been available in trading books, in interviews with successful traders, in the lived experience of every profitable trader who has ever shared their journey. For decades, the gold was always there. The only question that has ever separated the traders who made it from the traders who did not, is whether you were willing to follow rules that your emotional brain will fight against with everything it has. The rules are simple. Following them is not. But the traders who follow them consistently, who build the systems and pre-commitments that enforce rule following even when the emotional pressure to break them is at its highest, those traders do not wonder why they lose. They know why they win. 5 golden rules, written in gold, for a reason.